Good morning, everyone. This is Will Hershey of Yorkville Capital Management, and I would like to thank all of you for joining us on our quarterly MLP webinar. Today we will discuss why MLPs are currently an attractive asset class and why now is the time to potentially make an investment. Joining me on the call today will be Yorkville portfolio managers Darren Sharinga, Jim Hugg, and Len Edelstein. We will begin with prepared remarks and presentation by Darren, and will then enter into a Q&A session. Please enter any questions that you may have during the course of the presentation in the top left of your web applet. With that, I will turn it over to Darren.
Well, good morning, everyone. Thank you for joining us on our quarterly call. MLPs, why invest now? That certainly is a hot topic, and we've been getting a lot of questions from our current as well as prospective investors. The first slide we're going to look at, and ultimately we're having a little bit of fun on today's call. We've come up with a top 7 list of why invest in MLPs now. The first slide looks at energy equities and their performance in 2014, and a big theme of the call today is MLP business fundamentals are not tied to energy prices. And most of the slides will address this in some form or another. The conventional energy business model is output multiplied by the commodity price equals revenue. As a result, if commodity prices contract and output remains stable, your revenues will decline. As a result of declined revenues, your profit will decline, and your profit margins will decline more than likely. That is not the MLP business model. Most investors assume that MLPs fit into that business model in general. The MLP business model is really leased or contracted capacity, and we view it as a better way of looking at it. It's more akin to renting office space. You don't pay by the employee, you rent your space. And whether you put 1 employee or 10 employees in there, it doesn't matter. The rent per month will be the same. And that's essentially the MLP business model, the infrastructure model. You're leasing capacity on a pipeline. And ideally, it's take-or-pay contracts, which are just what I described there. So if you look at energy equities, the performance in 2014, you see that infrastructure MLPs that fit into the business model I just described, we're up 14% on the year. MLPs, as measured by the Yorkville MLP Universe Index, which is a passive benchmark that contains 100% of all master limited partnerships, was up 7% on the year. And you compare that with the S&P 500 energy sector, which has the business model, generally speaking, output multiplied by commodity price equals revenue, was down 8%. You look at commodity MLPs, which longer term have a similar business model, output multiplied by commodity prices equal revenue. We're down 22% last year. Oil service companies down 24%, and exploration and production companies, which clearly have the business model, output multiplied commodity price equals revenue, we're down 29% for 2014. So the benefit of the leasing model is MLPs generally produce less volatile performance than other energy-related investments. So why invest in MLPs now? The first reason, upgrade your energy exposure into an asset class where the investment performance is not tied directly to commodity prices, which commodity prices are extremely difficult to predict. The next slide in the presentation looks at the fundamentals of MLPs. In the most current pullback of oil, we've seen oil go from 105 to below $50. And as I stated earlier, fundamentals, the cash flow, or what we like to look at when investing in MLPs, the distributions or the income that we receive as investors, is not tied to the price of oil and natural gas. So Yorkville created 2 scores after the Great Recession of 2008 and 2009 that helped investors monitor the health of the MLP asset class. And by saying the health of the MLP asset class, it's really the investment thesis that underpins MLPs and that makes them different than any other investment on a global basis. And that is MLPs offer high, stable, and growing income. And our two scores measure the stability of income and the growth of income across 100% of the partnership. So it's a truly transparent score into looking at what's going on across MLPs, again, as an asset class. The stability score, the left box, shows a 9.5. The stability score goes from 0 to 10. A score of 10 means 100% of all MLPs maintained or increased their distributions in the current period. A score of 0 would mean 100% or every MLP cut its distribution. In the fourth quarter of 2014, 95% of all MLPs maintained or increased their distributions. When you look at the second score that we created, which is the growth score, you see that over that same period of time, in light of, again, oil prices dropping from 105 to 50, so if the business model was, again, output multiplied by the price of a commodity, you would expect growth to have declined. In this case, growth was across the asset class. Distributions, cash received by us as investors, increased by 5.6%. So why invest in MLPs now? The second reason, fundamentals are not tied to commodity prices. And again, as fundamentals, we mean the cash that we receive as investors is not tied to commodity prices. Now, this is a current picture from the fourth quarter of 2014. Arguably, an investor could say, this hasn't accounted for the impact of oil prices yet. It needs a few more quarters. So in order to explore that logic a little more fully, we go to the next slide. And what we did then is we looked at historical performance. And we went back to what I believe is the greatest stress test that any investor can look at, which is the Great Recession and the financial crisis of 2008. It will give an investor the clearest picture of what the risks are in any asset class, or if you're looking at an individual manager, what that manager's risks are in managing through the most difficult market that any of us are likely ever to live through. So in 2008 through 2009, when oil actually dropped further than the current decline from 140 down to the low 30s per barrel at its trough, MLPs, in the first bar of the MLP universe, 82% of all MLPs maintained or increased their distribution. That would produce a stability score of 8.2%. So the vast majority, in the greatest recession, in the commodity price where it dropped over 70%, of MLPs maintained or increased their distribution over a longer period of time. Again, to account for, is the fourth quarter not reflecting the full impact of commodity prices? Well, now we're going back to the Great Recession, and still the asset class showed resiliency among two headwinds, commodity prices and a global recession. The second graph or bar here, which is the Yorkville MLP Core Income Strategy, which is our actively managed strategy. Where do we add value as Yorkville? Is 100% of the names in our portfolio through the Great Recession maintained or increased their distributions. So we actually did better, and this is the stability, greater stability is the first component of what we look to deliver across all of our products with fundamental alpha. We want to shepherd our portfolio and our clients' assets into the highest quality names. And one of the measures we have is stability. So 100% of the names in our portfolio maintained or increased distributions through the Great Recession. This next page is very busy, but we're staying with the idea of historical data and looking at correlations again. And here we're exploring price performance because, again, we're very big on transparency as a firm. We want to provide investors with the underlying data that we look at. I'm not going to spend a lot of time on this chart because the next page gives a nice graph that looks at all of these averages. But what this page shows is the top 10 oil declines since 2000 and the performance of MLPs from peak to trough of oil then 30 days post the trough through 360 days. We provided this page and this table so that you could look it up on the website and be a resource if you wanted more information. One of the things I do want to point out, if you look at the second line from the top, 620 of 2014 through 128 of 2015, that's our current period. It's the second worst decline in oil prices in the past 15 years. The price of oil has dropped 58%. The only time that was worse than that is what I just looked at, the Great Recession of 2008 into 2009 when oil dropped 76%. So for a stress test, this is the second worst period of time that we are in relative to pullback in energy prices. So a summary, the next page of that table. The top 10 oil declines since 2000. If you look at the first chart, bar chart on the left, the peak to trough, it shows you that energy prices, oil prices, declined on average of 37.6%. MLPs declined an average of 5.1%. Again, a less volatile way to play ultimately the shale revolution in the United States. Again, less exposure to commodity price, fundamentally not driven on that business model, volume times price equals revenues, but a leasing model. So you'd expect returns like this. On the pullback, MLPs only declined 5.1%. What you see in the next one, 30 days post the trough, MLPs within 30 days of the trough of oil recoup their losses. So if you bought MLPs at the worst possible time, if the peak of oil is truly the worst possible time, you would have recouped your losses once oil troughed within 30 days and actually made money, been whole. So you look at it then on the far end, 360 days, 1 year after these big pullbacks, these top 10 pullbacks, MLPs have produced positive returns of over 20%. So why invest in MLPs now? The third reason, they've historically posted strong returns after major pullbacks in oil. Moving to the next slide, we're looking at what I believe is one of the primary reasons of why any investor would add MLPs to their portfolio. And again, the primary reason is high, stable, and growing income. That's what makes MLPs unique from all other asset classes. And due to that, those fundamentals and those attributes that aren't tied to commodity prices, you get an asset class that has low correlations to other asset classes. So the benefit of adding MLPs is it enhances portfolio diversification. One of the ways that we as investors analyze correlations, analyze how asset classes move together or are related to each other is through a measure called correlation. And a correlation of 1 means asset classes move perfectly together. If one goes up 10%, the other goes up 10%. If it drops 10%, the other drops 10%. So that would be a correlation of 1. So if you look at master limited partnerships unto themselves, when their correlation is 1 because they're the same asset class. Then you look at MLPs relative to equities, commodities, and fixed income, which are the 3 different segments of this table here. On the top are equities. And you look at REITs, utilities, and U.S. equities, which is measured by the S&P 500, you see that there's a very low correlation of 0.4 to 0.3 across the board. So what this tells us, a correlation of 1 would say MLPs are just like equities. Well, with these correlations, MLPs are very different from equities. And you look at commodities, and that's one of the themes that I've been speaking to so far, is you look at the correlation relative to crude oil, natural gas, or aggregates, the middle section of this table, and you can see that, again, if MLPs were correlated to crude oil, it would have a correlation of 1 highly. It has a correlation of 0.3, 0.13 to natural gas, and 0.38 to aggregates. That's because the MLP business model is not output multiplied by commodity price equals revenue. It's a leasing model, leasing of capacity, more like a real estate model, but what we're leasing now is essentially U.S. energy infrastructure. And finally, if it was just income, that MLPs produced and there was no growth, you'd expect a high correlation to fixed income. And we look at it relative to high yields, U.S. 10-year Treasury, and then an aggregate bond index, and it's most highly correlated to high yield and slightly negative to aggregate bonds in the U.S. So even if you're looking at it for a fixed income substitute in a bond portfolio, it adds diversification benefits because it's not only high income, but it's stable income like bonds, and then the growth is an equity characteristic that doesn't exist in other fixed income investment alternatives. So diversification benefits, you're reducing your portfolio risk by adding MLPs, you're increasing your income, and you're enhancing your returns. And why is that? MLPs are an alternative asset class that is not equities, that are not commodities, that are not fixed income, and that's because it's U.S. energy infrastructure and it is just different. So the fourth reason why invest in MLPs today, it enhances portfolio diversification. So moving on to the next slide, energy MLPs have low correlations to oil. Again, we've been discussing this. In the short term, you're looking at the top line here, which exploration and production companies, you show a 0.9 correlation. A correlation of 1, again, shows a perfect correlation. So this is almost, right now, E&P companies relative to the price of oil have been almost moving in tandem with them. That's how bad E&P companies have been hit. Historically, the correlation on the black line, longer term, since 2000, has been 0.3. What we would expect to see over time is that these relationships, these correlations, the way two different asset classes move over time, will come back to where it's been historically. And right now you can see there's been a spike to a much higher correlation relative to the price of oil across the board. And now in E&P it went to 0.9, but even at propane MLPs it went from 0.1 to 0.4, which is an increase of 4 in correlation. So there's been a tremendous spike recently in this pullback in oil. Our argument here, and what we'd expect to happen, is that over time the correlations will move back into where they have been historically. And why is that important? Because the correlation spike is really investors who have erroneously grouped MLPs with other energy-related assets. And again, gone back to that business model and said, okay, I understand energy investing. Output multiplied by the price of commodity equals revenues, and that's not the MLP business model. So the fifth reason of why invest in MLPs now, a rebound in MLPs is not contingent upon a rebound in the price of oil. And we're going to touch on why we think that's really important in a minute. Looking at the next slide, price dislocations provide good entry points. Again, we went back to 2008 and the Great Recession, a great stress test, as I stated earlier. MLPs pulled back 40%. In 2009, they had a tremendous pop of 80%. Why? Fundamentals. 80% of MLPs maintained or increased distributions over this period of time. We had a yield rally. Investors recognized the quality of the income that MLPs were producing, and ultimately MLPs corrected quite rapidly in 2009. So the sixth reason for why invest in MLPs now, buying on dislocations has produced outsized returns historically. So buying on dips has been a good strategy for MLPs, and that's not always the case. In MLPs, it's been a good strategy because fundamentals are not tied to commodity prices. They're not weakening. It's not because fundamentals are weakening is why a pullback has occurred. It's generally due to some other technical reason that the market is misreading the fundamentals, and gives investors a great entry point. And we have one of those today now. So that's the sixth reason. Buying on dips has produced outsized returns for investors. The next slide looks at 12 months returns of MLPs based on spread. And if you pushed us at Yorkville, what's the most important measure of MLPs from a valuation and return perspective? This is income investing. We would say yield and growth of income, the combination thereof. So when you look at one of the measurements of yield is spreads relative to other fixed income alternatives where investors can put their money. Currently, the spread between MLPs and 10-year treasuries is sitting at 130. It's sitting at 450 basis points, so 4.5%. And the line that shows that is on a historical basis. When MLPs have been at these rates, the market has produced outsized returns going forward of over 20%. So at this point, given the pullbacks that MLPs have seen in tandem with the price of energy or the price of oil specifically, why invest in MLPs now? The seventh reason, valuations are attractive. This is supportive of a good entry point based on spreads over 10-year treasuries. So that really talks a lot on what's going on with MLPs and the business model and the lack of correlation to oil and natural gas to commodities. And now we're going to shift our focus a little bit to oil. Clearly, it is very important on a global basis, and we want to take a few minutes because we've had a lot of questions on what to expect with oil and the price of oil. And let me state, given the business model of MLPs, when we are fundamentally analyzing the companies that we invest in, we are not factoring in the price of oil, generally speaking. It is not part of the analysis that we're looking at. We are, again, the drivers of the business model are not contingent upon commodity prices. We do have an opinion on it, and we'll share our knowledge of what's going on in the oil markets currently. Where do we find ourselves today on a global basis? We are in a oversupply situation. And what does that mean? Global supply has outstripped global demand. And there are a number of different sources of data that talk on what the global supply of oil is, measured in millions of barrels per day is a common measurement relative to global demand. And what you see is that whatever number you use, there's a slight oversupply. So global supply currently is measured by EIA, 92.9 million barrels per day, and global demand or consumption is 92.6 million barrels per day. And this tiny line, you can barely see it on the right-hand side, shows a surplus of 300,000 barrels per day. That tiny surplus has caused oil to drop from 150, if it's only fundamentals, to below $50 at its most recent trough. So the situation that we're facing on a global basis fundamentally is a very slight oversupply in the market. So the question becomes, there's two questions. One is how fundamentally will we globally adjust the supply to meet demand? Well, there's one of two things. We'll either bring supply down or we'll increase demand. And we're going to deal with the supply side on today's call. So global supply, and we think a lot of the balancing of the global supply will fall upon the U.S. because the U.S. is a market that is driven by economics and the capital market. So in order to amass capital and attract capital, you need to produce positive returns that are attractive to investors. So in order to bring global supply down relative to demand and bring the market back into balance, which means no surplus, no deficit, we need to see CapEx budgets come down will be the first part of the equation in the United States. And CapEx budgets are budgets that the large integrated oil companies are spending on exploration and production, so looking for new resources, and one, to increase reserves, two, to increase production, and that E&P companies that focus on exploration and production are spending to drill for more, to increase their production and increase their reserves, which is their business model. That's how they generate value for their investors. We've already seen CapEx budgets come down in the United States, and it's been across the board where we've seen cuts as high as 50%, and some of the major integrateds 15%, and somewhere in 30% is is what we expect CapEx budgets to come down in the United States. The next slide, CapEx budgets will come down. So what does that mean? It means less drilling will take place in the United States, and ultimately there's a direct correlation between the amount we drill and what production looks like some months later down the road as the wells start to come online. So there is a lag. CapEx budgets get cut, and we're starting to see the budgets in December. There were the first announcements of cuts. There were more in January. The budgeting process will finish in February. We'll get our CapEx numbers. That will impact the amount of drilling. As you can see here on this next slide, rig counts. So rig counts are rigs, they're drill rigs. Drill rigs have come down, so rig count declines have been 19% from their peak. Currently, we expect that rig counts and the CapEx budgets that were made this year were based on oil, in the $50 range. So current CapEx budgets, if oil stays in that range, are probably going to remain stable. We would expect that rig counts from peak to trough, this one will probably come down a like amount to the budget cuts in the mid-30% range. So we haven't seen the end of rig count reductions in the U.S. currently. Again, CapEx budgets get cut, rig counts come down, and finally that rolls over into the amount of production, and that's what we look at in the next slide. Remember, there's a lag to everything. CapEx budgets are just coming down. We've seen rig counts come down by 30%. Production levels are at 30-year highs in the United States. And what's interesting here, if you look at over the past 3 years, our numbers coming from 6 million to 9 million barrels, that's 3 million barrels per day of increase in production. That increase in production equals globally the new amount of production that's come online. So what we'd anticipate this year and what we're watching fundamentally for stability in price is that the production levels flatten out in the United States this year. They may be slightly up depending on where the price of oil balances, but exiting in the 9 range, plus or minus a few 100,000 barrels a day is probably enough to fundamentally, given the demand growth, which we're not speculating or talking on today, should put the market back in balance at the end of the year. And that will, again, give a floor to commodity prices. And so where are we today? We've seen quite a rally in oil prices from their trough. Can we say it's fundamentally driven? Not at this point. Production levels remain high. Inventory levels came in at record levels today. So I think that we should expect more volatility in commodity prices going forward. That I wouldn't call this the bottom of the market based on commodity prices. Again, given the first part of this webinar, commodity prices are not tied to fundamentals. And again, we have very sound fundamentals across the MLP asset class. So the Yorkville core income strategy, moving from MLPs, the macro story on balancing the global energy markets and the price of the commodity. The Yorkville MLP core income strategy, our goal here, and as the slide says, is to deliver fundamental alpha. And we measure that in 2 ways. We looked at the stability score. We want to, again, offer greater stability in our portfolio of income. Again, going back to 2008 through 2009, 100% of the names in our portfolio maintained or increased their distributions. More importantly, we need both, right? Without stability, we're not worried about growth. So it's not more importantly, but from an investment theme overall, we would argue that MLPs are a total return story based on income, but you want growth of income because that's what differentiates the asset class from any other asset class globally. The amount is growing, the growth potential we can find in MLPs. The growth across our portfolio in the fourth quarter was 25.4% on average. So let me put that in perspective. The asset class grew a little over 5% distribution growth. Our portfolio grew at 5 times the rate of growth of the asset class. If it continues to deliver growth rates at these levels, you would be doubling your income, or this portfolio would double its income every 3 years to investors. Now, I know most of us would love it if we were doubling our salaries every 3 years, or our compensation every 3 years, or income in our portfolios every 3 years if we're retired. This asset class, based on the most recent quarter, was growing at that rate. And we're not saying that 25% is what we think over the next 3 years, but we do think that something in that across our portfolio in the mid-teen level is doable based on infrastructure projects in the pipeline, no pun intended. So significant growth potential coming out of the asset class. And our view is really simply, if we're delivering higher stability, not cutting our distributions regardless of what goes on in the commodity market, and we're delivering growth along these lines, over time these fundamentals will produce superior total returns relative to the asset class. And so by focusing on fundamentals and delivering fundamental, we believe long-term that will translate into better total returns for a Yorkville portfolio than it would if the money were invested in MLPs elsewhere or in broad-based beta exposure to the asset class. The current yield of the portfolio, 4.9% versus 5.7% for MLPs overall. That 4.9% is more in line with what you get from infrastructure MLPs than the broader asset class. You're giving up, in our strategy, a little bit of income, measured by less than 1%, to pick up almost 5 times, based on the next slide here, 5 times growth in distributions over time. We believe, and we've stated on numerous calls, if you just look at the total return potential of the asset class, a great back-of-the-envelope calculation is your current income plus your growth in distributions equals your total return potential of an MLP investment. So we're very optimistic on what the return potential is of our MLP core income strategy going forward, regardless of what happens with commodity prices. I can't stress that enough. Our core income strategy, recent returns looking at 1, 3, and 5 year, ending December 31st, 2014. Last year we were up 5.7%. Outperformed a benchmark that's broadly known in the asset class called Alarian. That was up 4.8%. Underperformed the S&P 500 last year. You look at us on a 3-year basis, again, we're the first line, the MLP core income strategy, 3-year annualized returns and 5-year annualized returns north of 20%, has delivered significant alpha over MLPs, whatever measurement you use, whether it's the universe, 100% of all MLPs is measured by the Yorkville MLP Universe Index, or the Alarian Index, or the S&P 500. And that was, again, it's this not only high, stable, but growing income drives this price appreciation of the overall asset class. So the next slide, again, looks at our 1, 3, 5-year numbers and the positive alpha of really almost 9% per annum over what an investment in the S&P 500 would have done since inception. And since inception is important because inception, we're moving into our 14th year of managing MLP portfolios, and that means we are one of the oldest and most experienced managers in the space. Currently, we were contacted by pension and investment magazines to say that we will be in the top performing MLP managers again, and recognized in the most recent edition coming out soon. I know our Morningstar rankings through the 3rd quarter, we were number 1 on a 1-year basis, number 1 rated and ranked manager on a 3-year basis, and we're the 4th rated manager on a 4-year basis. So not only have we been investing in MLPs for a long time, offer one of the most seasoned investment teams, we're really good at what we do. It's because we stay focused on fundamentals, and we understand that fundamentals will ultimately drive investment performance. So in conclusion, I'm going to open it up to Q&A. MLP's core income strategy is the blue chip growth investment in U.S. energy infrastructure. Yorkville, based on Jim and Len's extensive investment in researching this asset class since virtually the inception of it in the early 90s when they first came across MLPs, has recognized not only the stability of cash flows, but that this is ultimately a total return story. And so we still focus, once we have the stability, on what are the catalysts for, the clearly identifiable catalysts for future distribution growth. So we're highly comfortable that our portfolio will continue to grow regardless of what commodity prices do, like it did in '08, and that the growth rates will still materialize, again, in spite of the volatility that we would expect to experience in the price of oil for the coming months as this global oversupply settles out. So thank you for your patience in listening to my prepared remarks. I'm going to open it up for Q&A, and I'm going to hand it back over to Will Hershey.
Thanks, Darren. Very informational and educational presentation there. We will now start the Q&A session. Just want to remind you, although we do have a queue already here of questions to go through, that you can ask any additional questions you may have in the top left box of your web applet. So with that, we'll get started. And why don't we give Darren a break here and go over to Jim or Len with I think what's a pretty prescient question here. And it comes in, how have total return expectations shifted for the MLP asset class as a result of the decline in commodity prices and the new commodity price environment that we appear to be headed for? Jim, you want to take that?
Sure. We had, I think, envisioned that, probably a beginning of last year that we'd see somewhere between a 7 and 9% increase in distributions. And what's happened since June, when the price of oil started to really plummet, we've adjusted those estimates down, and I think we feel comfortable now that instead of 7 to 9, it's probably going to be more in the 4 to 6, something like that. So we're clipping 200 to 300 basis points off of our original growth estimate. That's still a decent increase, and we'll wait until things settle out a little bit more before we take a look at what our projections might be for 2016.
Thanks, Jim. Let's move on here. Getting back to rig counts, and obviously important macro driver of oil prices and gas prices as well, but let's focus on rig counts overall. How much further, Darren, I'll leave this to you, how much further do we think rig counts are likely to decline here?
Okay. We expect rig counts to decline roughly in line with CapEx budgets for 2015. So they're down 19% currently. We saw a big drop in the most recent data that came out, week-over-week data of rig counts. So we think they'll drop 30% from the peak, the current peak, to this trough. It's our expectation that 30% decline should be enough to mute production growth coming out of the U.S. exiting this year, 2015, so that we can see a balanced market coming into the end of the year and into 2016. So we think, again, specifically a 30% decline in rig counts is what we're looking for.
Okay, and then I think just to follow on there, with that in mind, when do you think is and you addressed this a little bit during your presentation, but when do you think is kind of a rough timeline of when crude oil maybe stabilize and potentially, although by no means do we have a crystal ball, at what price, if you could give us maybe a rough estimate there?
Jim, I almost want to punt that to you because the crystal ball, mine broke a long time ago.
Well, yeah, I'm reminded that one foray, my personal foray into the commodity market took place about 30 some odd years ago after reading an article in Barron's about a particular commodity, and I went out and did something, and I never lost so much money in such a short period of time. So I'm going to say that, you know, projecting commodity prices is best left for people that really specialize in that. I think Darren, in his presentation, you know, made the point that that you know we're probably going to see a you know volatility in the short run and probably volatility in the long run. But I think the longer term, and by longer term, I'm being a little facetious here because normally I don't consider 6 to 12 months long term at all. But I think we're going to see, if I had to take a guess, that we're going to see somewhat higher oil prices, you know, by the end of the year. Again, we were surprised by the rapid decline in oil. We did not think that it would have the negative effect on MLPs that it has had, but and we certainly think it has been way overdone. I'm not talking about the decline in the price of oil. I'm talking about the decline in MLPs. Darren laid out a pretty compelling story as to why we think that they're undervalued. So that's kind of a punt on the question, but by the end of the year, you know, a higher price, and specifically, I don't know, $60, $70.
So let me add some data points around that. The CapEx budgets that we've seen come out this year from E&P companies are looking at oil in the mid-50 range. So exploration production companies are saying that on average for this to work for us, right, to generate economic profit from these wells, we need oil in the $55 range. And if we have that, it's fine. Our budgets make sense. The business is producing, again, it's profitable. So if we don't get that, we'll see further CapEx cuts at some point during the year, again, to fundamentally reduce supply and to bring the markets on a global basis, because oil is a global commodity, into balance. So I would think that if we see oil in the $55 range, the production numbers are going to be fine and the CapEx budgets will remain in place. So look at $55 oil as your kind of a mark that says, okay, production CapEx budgets were based on that, generally speaking, and that's a good gauge. So below that, probably more cuts coming in CapEx. Above that, things are looking pretty good overall. So I think that should help a little bit in a way of thinking about it. Where it ends up, the markets are driven by sentiment short term. Everything overshoots. It overshoots on the upside, it overshoots on the downside, and in the end, it comes back to fundamentals, and that's why we focus on the fundamentals, even on a company-by-company basis.
Great. Thank you, guys. And I think that question leads perfectly into a question relating to our MLP core income strategy, which is part of the focus of this call. And the question comes in, how exposed to lower oil prices is the MLP core income strategy?
Okay.
Pretty straightforward.
Yeah. So I'm going to do a little bit on just our portfolio construction and what the guidelines are and parameters, and then I'll tell you where we're at today. The core income strategy will always have a minimum of 70% of the portfolio invested in infrastructure names. So companies or partnerships, as they're referred to, will own infrastructure, pipeline assets. I'm simplifying things. 70%. And that's the minimum, and it can be 100% of the exposure. Infrastructure, again, given the business model that its leasing capacity is the safest place to be in an MLPs. It gives us the greatest amount of transparency, the greatest ability to forecast future distribution growth. So right now, in the portfolio, all but one name is an infrastructure name. are invested in infrastructure. So we're almost fully, our complete exposures to U.S. energy infrastructure names currently. The one name that isn't invested in infrastructure is actually an LNG shipping company that has long-term contracts that are dated currently 4.7 years. So again, it gives us the same type of ability to forecast on what future distribution growth looks like from the current contracts. So that's it. We're almost again all in infrastructure names currently.
Great, thanks. Len, I'll give you an opportunity here to take a stab at a question, and this is a little bit more higher level, just on MLP in general. But maybe could you talk briefly, and hopefully briefly for my sake as well, about the taxation of MLPs, and how complex are the tax rules regarding the distributions that you receive?
You want me to talk briefly because you're tired of hearing me talk now? The taxation is very complicated but very simple as well. You as a partner receive all of the tax breaks that any partner in any business would receive. And therefore you pay, you are not taxed on any cash flow, almost any cash flow. About 90% of the cash flow is tax deferred. The reason being there's depreciation, amortization of debt, all kinds of benefits to oil and gas operations in the United States. So what happens very simply is, assuming a $1 distribution, the likelihood is that 90 cents of the dollar will be non-taxed on a current basis. When the position is sold, there will be taxation on the portion that was tax deferred, and it's usually taxed as ordinary income. However, I hasten to add the value of $1 10 years from now is a hell of a lot less than it is now, in spite of current inflation deflation. Of course, there's one other way to beat the IRS, and that's to kick the bucket by holding the position, unless the Democrats take control in 2017 of both houses. Brief enough?
Okay. Perfect. Thanks, Jim. Oh, sorry. Thanks, Len. Jim, a question. Why don't you handle this one here? You mentioned that you expect to see an increase in new infrastructure investment, and in particular new pipelines. What exactly, given a lower commodity price environment, will drive new infrastructure projects going forward? Where will the growth maybe come from?
Well, the growth will come from places like the Bakken and other fields, where right now I think something like 80 to 90% of the oil coming from the Bakken is being taken out by truck or rail, and it's a heck of a lot more efficient to take it out by pipeline. But there are other fields, whether it's the fields in Texas, the Permian, or the Niobrara out in Colorado, Utah. All of these fields still need pipelines to ship the oil and gas out in a more efficient, and I might add, a safer way. I mean, I don't have to tell anyone on this call about the disasters that have taken place, particularly the one in Canada, where there was a whole town that was practically obliterated by rail cars blowing up. There's also demographic shifts that, as the U.S. population of 317 million isn't static. People move around, and you have to deliver the commodity, the fossil fuels, the oil and gas, to where the people are. So there's going to be more infrastructure that's going to be needed to satisfy the energy needs of the shifting population. So I'm not concerned about projects profitable projects over the next several years, 5 years plus, longer.
Thanks, Jim. Another question, a little bit changing topic here, but could you, Darren, maybe explain the difference between what in the industry is commonly known as midstream MLPs and what Yorkville refers to as infrastructure MLPs? And I'll just preface that for those of you who don't know, Yorkville maintains a suite of various classifications of the MLP asset class, which break it down in a unique fashion, which is what this question relates to, Darren.
And so, answering the question specifically, midstream MLPs would fall into what Yorkville classifies as infrastructure MLPs. So the terms could be used interchangeably, and you'd be talking about the same partnerships would fall into what we would say would be the Yorkville MLP universe, the Yorkville MLP infrastructure universe. And so we recently added a page on our website. Will, where's that page where you can look at all of the segments and sectors and ultimately industries of the asset class?
It's under our MLP education section. You can find it under asset class breakdown.
So that will give you more insight into the different sectors and then ultimately the industries that comprise MLPs as an asset class.
Great, thank you. Moving on then, I think this will have to unfortunately be our last question here as we're coming up upon an hour. So we'll answer this and then finish with just some concluding remarks. But Jim and Len, feel free to tag team this one. Given the recent Kinder Morgan consolidation and even more recent Highland purchase that they did in the Bakken, what kind of potential do you see for further M&A in the MLP sector? And on top of that, what kind of consolidation could we see?
The M&A will continue apace, especially given the low interest rates. Kinder Morgan, for one, has an enormous capital potential to make significant acquisitions, mergers. And we see others that continue. Energy Transfer's taking over Regency, TRGP taking over the two Atlas operations. I think it will keep going on. I think the intelligent, larger MLPs will see what is most contiguous and connected with what they are doing, and they will make offers which cannot be refused. So I expect significant M&A going on throughout the year, at least, if not beyond.
I concur with Lenny, and I think that it bodes very well when you see this M&A activity. It's one thing for us and for people on Wall Street to look at MLPs and think that they're undervalued. But when you have people that are actually there, like Rich Kinder and others, as Lenny mentioned, the Target people and others, the Energy Transfer folks, they see value, and that to me is a tremendous validation that they really know what's going on. We like to think we know what's going on. I think we do, but not to the extent that those folks do. They're the ones that are making these $100 million or billions of dollars of investments, and almost without exception, they have their own money on the line in having significant positions in the MLPs, so that that they're running. So they're putting their money on the line, and when they see things are undervalued, that makes me feel and makes us feel very comfortable about where we are.
Okay, thank you both for that answer. So at this time, we'll now conclude the question and answer session. If there are any outstanding unanswered questions in the web applet, we'll reach out to you offline. Additionally, feel free to call us directly with additional questions at 877-317-8128, or you can send us an email at info@yorkvillecapital.com. Also, several of you asked, a replay of today's webinar will be made available in the coming days on our website at www.yorkvillecapital.com. Thank you all once again for joining us, and we look forward to speaking with you on next quarter's call. Also, please keep an eye out for us in Research Magazine's Midstream MLP Roundtable, which will be released shortly. Thanks again, and take care all.